Welcome to another episode of Casey Lau's Money Tip Show. Today I'm going to talk about how to increase your investment return. How do you get better return that's way better than fixed deposit? How do you get at least a double-digit investment return rate? And the most important of all, how do you do it safely without risking your capital? First, let's debunk the myth of the saying that the higher the return you are expecting, the higher the risk you might need to stomach. Somehow this statement is true only if you are referring to those passive type of investors who don't know what they are doing. If you have no idea of how to invest your money and opt to just invest blindly, the statement is absolutely the truth. You want no risk at all? Just put money in FD. To increase your investment return, it is a gradual process. The more you learn something outside your comfort zone and become more competent in the process, the better you'll be able to access the risk, control your investment, and also apply suitable leverage. For examples, let's take the example of Susan. After being in the workforce for a few years, she only saves in FD. Without any investment knowledge, putting money in FD is the only comfortable option. Of course, getting 3% a year will not help in the long term. So she heard about unit trusts. After talking to several unit trust consultants and reading as much as she could about these managed trust funds, she gets more comfortable to put money there. First, she started with bond fund or fixed income funds, which has low upfront fees and safer in the long term. She started to get higher return, around 4 to 8% a year, which is really not bad compared to FD. Later on, Susan switched to equity funds when she understands how equity funds works. An equity fund invests principally in stocks, which can be actively or passively managed, like index fund. As she knows more about unit trusts, she is more comfortable to let fund managers to manage her money. Then Susan keeps on learning more about other various types of funds, which are categorized by whether they are domestic, Malaysia, regional or international. There are also like so-called specialty stock funds that target specific sectors such as green energy, commodities, properties, technology, etc. Anyway, unit trust investment is generally passive to the investors. You don't have to worry reading research or company report. The job has been passed on to the fund managers. You believe that they will do a better job than you, so you also agree to pay them the fund management fees, the agent's commission, and also the trustee fees. What if you want even better return? Warren Buffett from 1965 to 2005 has produced an annual average return of 21.5%, which is double the return of the S&P 500 including dividends over the same period of time. Meanwhile, George Soros generated an annual return of 30% through his quantum fund from 1970 to 2000, nearly 3 times the average return of the S&P 500. Of course, both Buffett and Soros are the greatest investors still alive today. They are fund managers and they do active investment. Active means they are doing it seriously, as a full-time job. In order to save costs, which is as high as 5% upfront fee for the equity fund and 1% per year recurring management fee, you might as well manage your own stock portfolio. In other words, you will need to step out of your comfort zone of being a passive investor to become an active investor. Just by doing half a decent job compared to Buffett and Soros, you might get 10 to 15% return investment in the local stock market. Other than stocks, you can also look into real estate. For the past few years during the property boom, many had made more than 20% capital gain per year. Becoming an active investor lets you call the shot. You have more control over your investment. By learning the right knowledge, you are able to minimize the risk too. If you are willing to put in extra effort, you can be an active investor. I have no doubt about your ability to do so in this positive environment. Well, there's still one big problem most youngsters face. To invest, you need capital. If you don't have much capital right now, no worries. You have time on your side if you are still in your 20s or 30s. So the next logical step is to get magnificent return, not just from the capital, but also from your effort, especially when you are still young and energetic. I'm talking about entrepreneurship here. business generated the most millionaires and billionaires nowadays, and normally within a much shorter period time frame comparing to getting rich through other types of investment. You might get 100%, 200% and even infinite return in the case you don't fork out any money to start a business. However, as good as it sounds, entrepreneurship is never easy. It takes a lot of time, effort, planning, courage, and guts to meet your end goals. As a conclusion, I want to echo Robert Arnold's saying, in investing, what is comfortable is rarely profitable. It is about you getting out of your comfort zone, keep improving and learning, and ultimately achieving magnificent return. I really wish you all the best, and thanks for tuning in to listen to this episode of Casey Lau's Money Tips Show. If you want more money tips and you want to learn about practical money hacks you can use right away, just go to my website at kclau.com, kclau.com. I'll see you there.